Welcome back to Portfolio, everyone. And in this video, we're going to do a stock battle between two of the largest financial institutions within the United States, JPMorgan and Bank of America. In this stock battle, we're going to go over some key financial metrics to determine which company we like more at this current point in time. We're also going to take a look at their overall performance over the past 5 years and take a look at some key financial metrics that will help us determine what we think the company is going to do moving forward. Every single Saturday, we do a stock battle between two different companies. And in this Saturday stock battle, we're going to do JPMorgan versus Bank of America. So thank you for tuning in, everyone. I am the Gen Z investor, and every single day we post about the stock market. We talk about different stocks you can buy, and we go over overall stock market performance and any other big stock market news and headlines. So please like and subscribe if you're interested in the stock market. And we're going to jump right into this battle between JPMorgan Chase and Bank of America. First thing I always do is start off with their price charts. Very simply, just get a perspective of how these companies are performing over the past 12 months. And you can see here, JPM is down over 13%. Since the month of March, they haven't really recovered back to pre-pandemic highs, where shares were being traded around $335. So a big decline over the past 1 year and not a lot of recovery. And on the 52-week chart, they are trading towards the low side. If we jump over to Bank of America, you can see here almost identical performance, down 13.4% as well. Same time on price chart, down since the month of March, nowhere near pre-pandemic highs of around $35 a share, and this company has been trading somewhat sideways on a slight increase over the past few months. And once again, on the 52-week range, trading towards the low side right now. If we take a look at their historical performance of how these companies have had a total return over the past 5 years, JPMorgan has returned 90%. So this is with dividends reinvested, they have returned 90% to shareholders over the past 5 years, which is a very nice return. Slightly outpacing the overall market, which has returned 85.4% with dividends reinvested over that same 5 years. And if we compare that 90% total return to Bank of America, which has returned 80.2% to investors over that same 5-year span, we can see here that in the past 5 years, JPMorgan has slightly outperformed Bank of America by a total return of 10%. And Bank of America has actually slightly underperformed the overall market, which has returned 85% compared to Bank of America's total return of only 80%. So you can see here, both of these companies have been performing very similar. Very close price chart, both down around 13 to 14% over the past 12 months. And total returns over the past 5 years are very close as well. Less than a 10% gap in total returns for both companies over these past 5 years. So we're going to jump right into the battle right now. Some of these key metrics are more important than others for banks. And one thing we're going to take a look at is some income statement financials. We're going to take a look at some balance sheet financials. And of course, we're going to evaluate that dividend. These are some nice dividend paying companies. And as investors, especially people who like to invest in financials, we love that high dividend income. So we're going to jump right into it. And the first battle is market cap. So why we include this is because it gives kind of a perspective for some of the following metrics, but also allows people to believe and kind of follow which company is larger than others and by what margin. So JPMorgan is currently being traded at a market cap of $308 billion compared to Bank of America around $220 billion. So JPMorgan wins this battle, and both of these companies are significantly larger than some other key banks. Citigroup and Wells Fargo, for example, both have market caps around that $100 billion range. You can see here JPMorgan and Bank of America much more valuable with regard to market cap than those other two competitors. If we move on, the first income statement measure we have to take a look at is total revenue in the past 12 months. So in the past 12 months, financials have been hit extremely hard. With the economic slowdown, the pandemic, financials and people spending money has been decreasing. So financials' actual total revenue has fallen as well. So this is both banks' total revenue in the past trailing 12 months. JPMorgan has brought in $97.3 billion of total revenue compared to Bank of America, which has brought in $76.6 billion. That is the top line of the income statement. Now we have to compare the bottom line. How much profit or net income have these companies brought in the past 12 months? JPMorgan has brought in $25.1 billion versus Bank of America $20.3 billion. So JPMorgan wins this battle. So far, they take a 3-0 lead. They are the larger company, so it is to be expected that they bring in more revenue and more profit. So as of right now, nothing too shocking with this battle. Now, the next key metric gives a fair comparison between the two companies. Profit margin. So for every $1 of revenue, how much is the company keeping to themselves on their bottom line of their income statement? JPMorgan has a profit margin of 25.8%, compared to Bank of America, which slightly outpaces them at a 26.5% profit margin in the past 12 months. So Bank of America and JPMorgan, very similar profit margins, less than a 1% variance, but Bank of America does win this battle with the higher profit margin. Next is revenue growth. So it's great to see JPMorgan have high amounts of revenue, but if the company isn't growing year over year, then that's not really going to help the share price or not actually help investor confidence. So what we like from companies is even these large mega cap companies like these two banks, we want to make sure they're growing at a decent rate year over year. So we're going to compare revenue growth. Top line revenue growth has a large impact on investor confidence, and investors who see companies grow that top line year over year believe the company has and sustain long-term future growth. So if we take a look at revenue growth, this is an average over the past 3 years. You can see here, JPMorgan has returned a 10% average annual revenue growth over the past 3 years, compared to Bank of America, which has 6.67% annual revenue growth. So JPMorgan has been growing revenue at a faster rate, which is great to see. Now, if we take a look at something that kind of compares the valuations of these companies evenly, is the current forward PE ratio. So this is a forward PE from Seeking Alpha, and if you were to buy into each company right now, this is the price to earnings ratio that you would be paying into. So the lower price to earnings ratio represents kind of a cheaper valuation for the company, that you are spending less money to purchase in $1 per company earnings. So Bank of America, with a price to earnings ratio of 16.3, wins this battle compared to JPMorgan's forward PE of 18. Next metric we have to take a look at is the price to sales ratio. Another metric where the lower number kind of represents a better price for the shares and a better value you're getting for the company. So both of these companies, once again, very similar price to sales ratio. Bank of America has a 3 versus JPMorgan at 3.25. So once again, Bank of America wins this quick battle. But once again, you can see so far, very close with regard of these companies' financials. Very close profit margins. Revenue growth, JPMorgan slightly outpaces, but a forward PE and a PS ratio very similar between both companies. Next is the juicy dividends. So for dividend investors, financials have been a staple in their portfolios for many years. And you can see here, JPMorgan with a current yield of 3.56%, beating Bank of America's 2.8%. But similar to revenue, we have to look at some other dividend metrics to determine which one may be more attractive. It's great to see that JPMorgan has a higher current yield at this point in time, but how fast are they growing that dividend? So JPMorgan has a 16.2% average annual dividend growth rate over the past 5 years versus Bank of America's 40%. So Bank of America wins this battle with a much higher dividend growth rate, but that is not sustainable. There's no way they will maintain that over the long term, but they have over the past 5 years significantly grown their dividend. A company like JPMorgan with a dividend growth rate of 16%, that is still incredible. That is a very, very fast dividend growth rate, especially when you're locking in a 3.56% starting yield. So both of these companies did cut their dividend during the financial crisis in around 2008 to 2010, and Bank of America at one point was paying out 1 cent per share, and JPMorgan was paying out 5 cents per share per quarter. So these companies have significantly grown their dividends since that point in time. They've done it at a very fast rate, but it is key to mention that they both did cut their dividend back during that financial crisis. And of course, with how we're going through the world right now, it was kind of unsure if we're going to see a cut in banks' dividends moving forward. Both of these companies actually did pass the Fed's stress test, so they are allowed to maintain their current dividend payment, while other banks were actually forced to slash their dividend. So it'll be interesting to see if they can continue, and that's why we take a look at the dividend safety score. So this dividend safety score represents the likelihood of a dividend getting cut. And what this is from Seeking Simply Safe Dividends, the website where they take a bunch of different financial metrics and compile a single number to help determine and show you and represent the safety of a company's dividend. So 60 for JPMorgan, you want a higher dividend safety score. The higher score wins. So JPMorgan wins this battle with a dividend safety score of 60. Both of these dividends are considered in the borderline safe category. So not considered unsafe right now, but not considered safe or very safe. Borderline safe, which represents there is a risk of that dividend getting cut over the next year. So it's nice to see fast dividend growth, high dividend growth rate, nice current yield, and a little bit of safety, not full safety on their dividend right now. But what is their company's payout ratio? So we're taking a look at earnings per share payout ratio. JPMorgan's right now is around 64% of earnings versus Bank of America's 46% of earnings. That just shows Bank of America is paying out less money in the form of a dividend with regard to per dollar of company earnings. So it's nice to see they have a little bit more money to reinvest back into the business compared to JPMorgan. But for both companies, these dividend earning per share payout ratios are very safe, very sustainable, and I believe they can maintain these ratios over a long period of time. Next is the total ratio. So we went over some income statement measures, we took a look at the dividend, now we're going over the balance sheet. So financials have different types of balance sheets. Banks, their balance sheet, you can't really evaluate the same way as you would a normal balance sheet, so that's why we're not taking into consideration the current ratio. Usually in these battles, you do a current ratio to see the short-term assets versus the short-term liabilities. But what we're going to do in this video is take a look at the total ratio. So overall assets divided by overall liabilities. And you can see here, very, very similar. Bank of America has a 1.11% total ratio, which wins this battle, compared to JPM's 1.09. So 0.02 difference between these companies with regard to their total ratio. So overall, very similar total ratio between these two companies, but Bank of America slightly outpaces JPMorgan. And the last measure we're taking a look at from the balance sheet is deposit growth. So this is the money where you or I deposit our money into the bank. The bank uses that money to loan out and gain interest and of course generate revenue. So why this matters is we need to take a look at how fast people are depositing the money into the bank and how fast JPMorgan and Bank of America are growing that deposits. So this is the deposit growth rate compared to the past 12 months compared to 2019. And why I chose that only 1 year rate was because during this pandemic, banks actually saw a jump in deposit growth. People were actually hoarding more money. They were not spending as much because they were locked in at home, and deposits actually grew at a very fast rate. So during this past 12 months, 23.6% deposit growth for JPMorgan compared to 19.8% for Bank of America. So JPMorgan wins this battle, but overall, very nice deposit growth. And why that's significant, even though that's put on the liability side of a balance sheet, it's because the bank uses this money to loan out and generate interest. They use this money to loan out to people for mortgages, for business loans. They use that money to invest in equities or private businesses. That's what banks use our money once we deposit into the bank to help them generate their revenues. So the more money we put into JPMorgan or Bank of America gives them more money and more power in order to acquire assets and actually generate future revenues for the entire company as a whole. So they need deposits to grow in order to help them grow top line revenue and earnings each and every year. So that was a stock battle between JPMorgan and Bank of America. We're going to go over to determine which one won this battle. So JPMorgan Chase has won 7 battles versus Bank of America, which has won 6. So JPMorgan wins the overall stock battle 7-6, but both of these companies are very similar and they have actually performed very similar over the past 5 years, and their current financial metrics are very similar. So I think if you were getting into the financial sector and you still believed in banks at this current point in time, and you were looking at the main 4 banks, JPM, Bank of America, Citi, and Wells Fargo, I believe these two might be your better 2 options. Wells Fargo did have to slash their dividend recently, and I think these 2 companies, with every brokerage out there right now offering free or fractional trading, You can split your money in the financial sector evenly between these two companies, or you can pick one more than the other. But if you want a little bit of diversity and you want some nice dividend income from the financial sector, even during this time of hardship, these are two companies you want to keep your eye on. So thank you for tuning in, everyone. I am the Gen Z Investor, and we post on this channel every single day. So I'll see you in the next video.